Hi folks, I'm Will Bridges from 123 Trade, and in this video we're going to talk about equity management, lot sizes, leverage, and really just how to try to protect your investment. That's really what this is all about. A lot of people want to know the difference between profitable traders and, well, traders that aren't profitable. There's a few common trading mistakes that I'm going to talk about and ways that you might be able to help avoid that. Really control your emotions while you're trading. If you like this type of content, we're going to put out lots of time-sensitive type stuff. This video you may want to watch a couple of times to make sure you're clear, because like I said, if you don't know how this works, I don't know if you can be consistently profitable trading anything. Okay, so if you like this stuff, then by all means, press the thumbs up, subscribe, ring the bell. Like I said, lots of time-sensitive material on this channel. More of it on our website if you visit 123trade.com/YouTube. We've got lots of videos on there for market updates, trading education, trading for beginners, and really our archived client-only live trading sessions that we do as well. But if you do click show more in the description below, there's going to be a lot more information about what's in this video. Like I said, you may want to watch this a couple of times because there's lots of information. And this here is a risk disclaimer. Cool part is that's what we're here to talk about managing, because there's no such thing as a guaranteed trade or a guaranteed win. If you put your money in the market, your money is at risk. Absolutely no one I've ever seen wins every trade, and everything in this video will be for educational purpose. You guys do with the information that you think is best. And let's get over, I need to get into a lot of trading vocabulary, just so you guys know what these words are. Oop. And really, first place we want to start here, let's get to the beginning of this. Lot sizes, equity management lesson here. Okay, if you want to manage money, you better know how to count it. That's really what this is about. So let's get into the actual meat and potatoes. Here are some common trading mistakes, and these are really, these two are the most common and the biggest reason why I've ever seen anybody fail or blow out a trading account or do anything that they didn't like in their trading account. Because anytime I've ever over leveraged myself, this means that, for example, if I had a $1,000 account and I'm risking $500 of this 1,000 on one position, I am over leveraged in that position. I am risking way too much. I have all my eggs in one basket, is really what that means. You guys have all heard that. I'm not the first person to tell it to you. It's good advice to not put all of your eggs in one basket. That's why you've also heard words like diversification. And that's, some people go overboard on diversifying, and that's what really comes down to overtrading. So you want to be somewhere in the middle, obviously. But overtrading, some people open a lot of really small positions in a lot of different places, and they'll just be so spread out that they don't realize that they have a mountain of positions. And right now, maybe 40, 50, 60, 70%, maybe all of my account is at risk, and I don't really keep track of it. A lot of people do that. Okay, so I would say those two common trading mistakes are the number one reason that I've ever seen for people to fail long-term trading. And opening trades with a stop loss that you can't emotionally afford. So if I open a stop loss that, hey, if this thing comes my way, I'm going to make $10,000. It's going to be incredible. Gold is going to rain down from the heavens if I win this trade. But a lot of people don't think about what happens if they lose. So sometimes people open with no stop loss. And I used to have t-shirts I used to make. I used to joke around with people. Stop losses are for losers, because it's also a pun. Yes, I like to joke around. But, if you're not using a stop loss, then you're risking your entire account. You have infinite risk for 10 grand, $100, whatever it is that you're aiming at. You have infinite risk without a stop loss. You could lose your entire trading account on that one decision just because you have nowhere that you plan to get out if things go south. Okay, so most brokers are going to have negative balance protection, so you can't end up typically owing money in that situation. But really, nobody wants to lose their whole account, so you don't want to go all in really on any one decision. There's going to be, let's just say there's 28 currency pairs that move every day. I want to be able to play the game tomorrow. I can lose today, win tomorrow, lose 2 days in a row, win 5 days in a row. No way to know 100% of the time, if you're going to win or lose. But, that's really the one thing that separates the winners from the losers long term, from what I've seen. The successful traders that I watch, 1 to 3% risk per trade, or in the market at a given time is something most people can stomach pretty easily. So it keeps you from making a lot of emotional decisions that you might be crying about later. And the reality is if I get 5% return per month, that's an 80% return per year. It makes you, let's just say most of you watching this video would probably be happy if you do 4 times what the S&P 500 does this year, and you absolutely demolish what inflation does this year. So, it's the boring traders that are making all the money. It's all about taking small bites. It's, if you want to become a millionaire, that $1 million is like an elephant. You're going to eat it one bite at a time, and money compounds. So your sword gets mightier with every swing, and that's really the cool part about trading. And some of you might be pretty new to trading. Okay, so if you want to measure your risk, you need to know, how the market measures changes in price. Okay, that's what a pip is. So a pip is a 1/100th of a penny in price movement, and the 2 blue letters there, okay, that's the 4th and the 5th decimal place. That is where pips are measured from. Okay, so this might be, something like the value of the US dollar to the euro. So, 1.14789 US dollars might be, 1 euro. So if this 7 were to move to, maybe it moved to 115, okay, that would be a 22 pip move. Okay, so maybe if it moves to, 1.1480, okay, that's going to be roughly, 1.1 pips. Okay, that's a small move. 1.1 pips with what we've got here. So 1/100th of a penny, small movement. Okay, so how do you make money? If the market's only going to move, 40 pips, which would be 4/10ths of a penny on the day, or maybe 2 pennies would be 200 pips in the day, then how do I get to make money? How does that make sense for me if it's only going to move a penny? And that's really where lot sizes, leverage, that's where all this comes in. So the size of the move, okay, is going to be small, but your ability to have a large position really makes it a day-to-day occurrence that you could potentially make money from. So you don't have to marry any of these trades. You can one night stand every one of them, or whatever it is that you want to do. But the truth is, you just have to know how much money is going into the trade. How much am I risking? We'll get more to risk reward as we go on here, but what is a lot? Okay, and a lot is a standard unit in the Forex. So if I know a lot is 100,000, base currency. So if my base currency is, the dollar or the euro or the Aussie dollar or the pound, whatever, then, and that's what my account is in, okay, then 100,000 base currency would be 100,000 Aussie dollars or $100,000. Okay, so 1.0 is 100,000. A mini lot is 1/10th of that. Okay, a micro lot is 1/100th of that. That's really all it is. You can do any multiple of micro lot, mini lot, or standard lot that you want. So if you want to trade 0.24 lots at a time and risk something like, I don't know, $2.40 per pip, then you can do that. Okay, it's just a matter of understanding what a lot size is. Okay, so this number is very important. I'm going to show you guys how to figure out really what your risk reward is. I want to show you guys how to multiply by 10 and figure out what your risk is pretty quickly. If you got a basic calculator, you can figure this stuff out pretty easily. Leverage. Okay, so for those of you that are new that are watching this is more vocabulary. And yes, you are probably going to want to watch this video again so you know what all these words are and what this stuff means so that you know how to, put your thinking caps on and go make equitable decisions later. But really, leverage just magnifies your position. Okay, so if the market moves 1 penny today and I have 400 to 1 leverage, that's a big deal. That's basically like a $4 move on a stock with the same amount of money. You guys with me now? Because that's really how this market allows people to have a daily opportunity. It's magnifying the size of the move with leverage. Okay, so margin requirement, we're going to get to on the next page here. Basically I have to give my broker some money to hold on to so that they'll open this bigger, I need some collateral for my position that I open. Okay, so really how that works, okay, if I want to open a standard lot position, which would be a $100,000 position in the market, okay, that's going to be a little bit over $3,000 with 30 to 1 leverage. Okay, that's what my requirement is. The broker is going to take that money, they're going to lock it up, and they're going to put 100,000 into the market for me. And then when I close that position, I'm going to make money based on the movement of that 100,000. Okay, so let's just say I close it out, I capture 30 pips, I made $300. So now that money comes out of the market, they unchain my margin requirement, I get my other 33 back, and then life goes on. I can go make more decisions, make more trades with that money. Okay, if I have 400 to 1 leverage, then they would be locking up $250 to open up my bigger $100,000 position over here. I make or lose money based on that. So it's really just magnifying, well, your loss or gain from the movement. So it's something, if you understand that there's going to be more opportunities every day, you don't have to marry any of these opportunities, because if you do, let's just say you probably love anything else that you've ever married, and if you lost it, you might be upset. So the key to being a good trader is to not get upset and set you up for situations where you can manage a loss, and you can also manage, to find some more wins later by being able to manage your losses. So like I said before, you all have a margin account if you are trading in the Forex. Okay, so the broker is going to lock up your required margin. Okay, little cage over there, small bag of money. That's your small amount. That's your collateral for the trade. Okay, and then the broker opens the bigger trade over here. You make money based on that. And then as soon as you close out, okay, then you either get the loss or gain from the big amount of money the broker put in. Okay, and then you get your margin requirement back. And all you paid was the spread and the cost of placing the trade. Fees. Okay, so that's really what this market is about. It's giving yourself, executive style position in the market with a small deposit up front. So, really, you need to pay attention to just not getting, caught up in the vanity of trading huge. You need to understand what the risk is versus your reward. Okay, so that's really what this all comes back to, is that can I deal with the risk? It doesn't matter what I think if the market's going to go up or down, because I could show you 2 different trading strategies in the next 10 minutes on the same currency pair, and one of them I'll convince you to go up and the other one I'll convince you to go down. I could show you guys both of those really in just a moment here. Okay, and it doesn't really matter, if I'm right or wrong all the time. Okay, as long as I'm right, 3.5 times out of 10, whatever it is, depending on my risk to reward ratio. So I can really, if I do this right, from what I've seen, then I don't have to win, even the majority of the time, to be profitable. I just have to make sure my losses are small, my wins are bigger, and make sure that I can afford all of the losses. I want to be able to afford, 20, 30 losses in a row, still have 70% of my account. Because I can dig out of that. I can't dig out of a blown out account with $0 in it. Okay, so this is something that's going to be extremely important. I'm going to go ahead and move on here. You guys are, I think, maybe a little bit scared sometimes by the fact that, some people are trading something up and some people are trading it down. Risk reward is the most important thing. That is the number one thing that to go along with every strategy, is that you can afford your trade. So this is how people screw up. Okay, I want to make sure everybody knows what these common trading mistakes are. When I say common, this is like the majority of people that trade are trying to trade too big, okay, or trade too many of small positions and risking much more than 1 to 3% of their account at any given time. Because a lot of people want to rush their success, and trading is about building wealth. The wealthiest traders that you know about, the Warren Buffetts of this world, boring. Okay, they're not stressed out about their positions. Okay, those guys come on TV. They tell everybody that they're going to be dumping their, airplane positions because no one's going to fly during COVID. And they risk an amount of money that they can afford. They have a lot of money, they can afford more. If you don't have billions of dollars, then don't risk hundreds of thousands of dollars on each decision. If you don't have thousands of dollars, don't risk thousands of dollars on each decision. Every decision you make has a value in your brain, just for the fact that you want to be right, for one, and two, can you afford to lose this trade before you open it? Otherwise, you're never going to be able to wait and let the trade play out, because if it dances toward your stop loss, you're going to panic. If you can't afford the stop loss and you haven't accepted the chance of losing this trade before you enter it, you're probably going to dump it. That's what most people do. So, let's check this out. Equity management, some best practices here in Smart Trader. I'm going to show you guys some live charts. Okay, let's pull this up here. And, this is the Euro USD, everybody's friend. Okay, this is probably the most commonly traded instrument in the history of instruments. Okay, if we come up to our all-time frame, Okay, and if I'm looking at a monthly chart, I'm going to be looking at relatively big moves. You know, this might be a few hundred pips here. I'm going to draw a couple trend lines here, show you guys an example. And there's our recent trend break. Okay, actually I need to get a line on the bottom here as well. And, you know, I think that this thing could work down to our cross down here, down at our lower level down here at 110 or so. Okay, so that's about $1.10. We're at about $1.18.9 right now. That would be a heck of a move down. It's already come down 200 pips, I think, just in the last few days. Let's go ahead and get into a lower time frame here. I want to get some more confirmation for myself, what direction I think this thing might be going. You know, I'm going to show you guys a way you could trade this in either direction, which I think might drive some people crazy. But really, the most important thing is that you follow risk reward, because some people are going to trade with the trend all the time. Some people don't know what direction that is. And, you know, even if you do know what direction that is, that doesn't mean it can't change with a speech from somebody later today. So all that said, anything can happen. Okay, there's tons of news in the world every single day. And even if you read all of it, there are things that don't get reported that the governments, central banks of this world decide to do, you know, without telling you. I know, big surprise, they don't tell you everything. But, you know, to me, this looks like it could be a downward move. And, you know, hey, maybe it comes up. If we look at this in a sense of a trend, okay, this is what I might look at for a sell opportunity. And, you know, if I think it's going to come down all the way to, you know, 110, for example, that'd be all the way down here. There's 110.5. It was a real popular price for a while. We got lots of action at that price for, well, a good number of years. Okay, so we kind of hovered around it for, you know, this 3-year period, and we came back and visited it again here for another 6-8 months. And, you know, maybe we come back and do it again. It seems like that's like our every couple of years vacation. We like to spend some time at the 110 range. So, you know, maybe we get there, maybe we don't. Okay, I don't know 100%. Neither does anybody watching this video or anybody that is looking at this chart. Unless they've run the Federal Reserve and the ECB or the IMF, there's about 7 people on Earth. You know, there's really no way to know exactly what's going to happen, and they don't know either, because they don't know what's going on with inflation right now. Just for example, depending on when you're watching this, that's probably going to be true later too. But now what I want to do, I want to figure out where my current market price is. Okay, so here's my current market price. I'm going to make this one blue. I need some perspective. I need to see how far this is, what my potential reward is. I want to know how much money I can make. Okay, so now I need to figure out, okay, is the risk worth it? Okay, so let's get a red line on here. Let's get a previous high. And that looks like better than 2 to 1. Okay, so check number 1, risk reward ratio looks solid. Okay, and I can measure that too. If I measure from my red line to where my stop loss might be to my current market price, we're talking about 383 pips. Okay, and to my target, we're looking for 838. So more than 2 to 1. I'm very happy about that. So this might be something I let rip right now. And, you know, I've got to figure out how much money do I want to risk. So we say this was on the top here, is 380 pips, we'll call it, just to be safe. Say 380, okay? And maybe we just want to do a, typo, 380. Our limit on the bottom, maybe we just want to clean this up, make it a clear 2 to 1. Maybe I just do 760 pips. So I aim a little bit higher than what my target really is for my analysis. I'm just going to look for 2 to 1 on my money. Now I need to know how much money I'm risking. So right now there's a 1 here. Okay, so if I want to know how much money would be attached to this stop loss, should I lose this trade and this thing just come against me and I lose, okay, I need to multiply what's in this box, what I have highlighted here, okay, by 10, and then multiply that by this. So I have 10 times 1 times 380. Okay, and that's going to give me 3,800 is roughly what my risk would be on this trade with a 1.0 standard lot position. And if your leverage is 400 to 1, you might pay $250 in margin requirement to open it. Okay, so then you're going to need, on top of that $250, you're going to need another $3,800 to manage this position and, well, not get stopped out by the broker before you get to the stop loss. And you don't want that to even be a factor. So otherwise, you may want to trade something smaller. And maybe you're the type of person, maybe you want to trade, I want to risk something no more than $40 on a decision. Okay, so if that's the case, then maybe I want to do a 0.01. Okay, because if I do 0.01 times 10, okay, that gives me 0.1 times 380. So 10% of 380, $38. That's something I can sleep at night with. Off to the races. Okay, so really whatever you put in this box times 10 times the number of pips that you are risking is, how much money you have at risk, roughly. Some pip values might be a little bit different. The slower movers actually typically have more valuable pips. So that stuff kind of balances out, but that is something that you should pay attention to on every single trade. Am I okay with losing this trade before I get into it? Because if I'm not okay with losing it, what is my brain going to do to me? If the market does one of these and it sneaks up here and it just creeps towards my stop loss, am I going to hold it or am I going to dump it? What am I going to do? Am I going to wait for this to happen? Probably not. Okay, more than likely I'm going to panic and get out before the market comes within my plan because my stop loss is up there. But a lot of people make that mistake regularly, and a lot of people get out too early. They just can't stick to their plan. So maybe you're not the type of person that can wait 6 months, maybe 5 weeks, however long this trade takes to develop. So you don't want to put yourself in that situation. Maybe you can't risk 380 pips. Maybe you get too excited to win anything bigger than 40 pips. Okay, then maybe you want to trade on a smaller time frame. Let's go ahead and delete this stuff out here. Okay, let's come down to maybe our 15 minute, maybe our 30 minute. And this is much more popular for scalpers. Maybe this is a much easier decision. We've already looked at our high time frame. I've already decided that my trend is downward. It is on this low time frame here too. Okay, so we've got a counter trend line break here. If I get some Fibonacci levels from the top of this wave here, maybe I just look for a scalp position. Stop loss above my current range here. Get my current market price in here with blue. This is my favorite one to draw because it's easy. But I need it for perspective. I need to know what I'm measuring against. I need to know what my risk-reward ratio is. And this current position here, maybe this is high probability, maybe it's not. Okay, so this market could come up, it could come down. There's no way to know. Okay, but right now, this looks like a 47 pip risk for a 60 pip opportunity. So it's about a 1.2 to 1. So some traders will take that, some people won't. That may be your cup of tea, maybe it's not. Okay, but the truth is that if I'm going to take trades like this, I need to be right a little bit better than 4 times out of 10 if I want to be profitable. But now this is a smaller amount of pips. Okay, so maybe the ideal place for me to get in this is probably up at my 618 because it doesn't look like we've actually retraced there yet. So maybe this is my 618 up here. Maybe that's where I finally want to get in. And this is a much better risk-reward ratio because now what I'm looking at is an opportunity where if I'm a little bit more patient and I negotiate a better price with the market just by waiting longer, then I might be able to risk 25 pips to try to capture 82. So then I can put a 25 over here for my risk. Actually, I need the right box here, 25. And my bottom side, look for 80 pips. Okay, so this is a little bit different. Okay, so if I still wanted to be that $40 person, for example, I don't want to risk more than $40 on any given trade. If I risk a 0.1 here, for example, okay, times 10, times 25, okay, so then I would have 0.1 times 10 is 1, times 25 will be $25, okay? So if I wanted to risk, say that $40, then I might do, a 0.18, okay? So now, okay, I can have more or less the same amount of power behind each of my decisions, no matter how many pips that I'm risking, no matter what kind of trade that I place, because sometimes the market's going to be trending and sometimes it's not. Sometimes I might want to focus more on scalping because the market's going sideways. Okay, so maybe I want to look for smaller movements in the market, but I want my decisions to hold the same value. Okay, so then you can really follow what your win-loss rate is with a sense of purpose, because then your win-loss rate will actually mean something. Otherwise, this can be, well, your win-loss rate, if every trade you place is a different size, then your win-loss rate is irrelevant. You could win 99 times out of 100 and blow out your account. That's really what it is. If you're trading a different size every time, you're going to have a very confusing path towards success. And I hope that I've cleared up a lot in this presentation here. If you do have, there's going to be a lot more coming. If you have questions, put them in the comments section below, okay? Because I know a lot of people struggle with this, and I could very easily show a strategy. Some of you might think that the euro is going up right now versus down, okay? So more power to you. If you can manage the risk, then more power to you. That's really what it comes down to, because I don't know, I can't guarantee you down any more than you can guarantee me up. So that's why you need to plan for the possibility of being wrong. You don't plan to be wrong, you plan for the possibility that you might be. Okay, so I hope you guys picked up a few things here today. Again, I'm Will Bridges from 123 Trade. Give us a thumbs up if you like the video. I hope I've earned a thumbs up at least. Just a quick click. Subscribe, ring the bell. We're going to have lots of time-sensitive information that comes out on this channel. There's a lot more information on our website. We have up to $22,000 in free trading tools and education to provide on our website on 123trade.com/premium. But you guys take care. I hope you enjoyed the video. Be good or be good at it.